They are ruined not by error in their choice of stock, but by error in their choice of moment. They are driven by the clock. They are obsessed with the precise tick of the ticker. They are desperate to catch the absolute bottom, or to sell the absolute top. This obsession is a form of madness. It is a fool's errand because you are trying to time the ticker when you should be timing the context. Timing a single trade, the day, the hour, is utterly impossible. It is speculation in its purest, most desperate form. It is gambling, plain and simple. But timing the fundamental historical phase the market is operating within? That is the only certainty available to the man of discipline. That is the necessary bedrock of all successful speculation. You must understand this. The market is not merely rising or falling. It is following a predictable structural narrative. It is moving through distinct historical cycles governed by the unchanging nature of men. If you employ a boom phase strategy during a consolidation phase, the market will not argue with you. It will not pause to offer a correction. It will simply liquidate you, efficiently and slowly, draining your margins day after day until your capital is exhausted. You must stop asking when to buy the shares. That is the amateur's question. You must start asking what historical demands the market is currently imposing upon you. The secret is recognizing that the market is never static. It is always cycling through 4 recognizable historical phases. Your survival, and your substantial fortune, depends entirely on adjusting your discipline to match the precise demands of the phase you are in. Master this recognition. Master the phase. You will master the timing. Subscribe now, like this video, and leave a comment. By doing that, you help more people see this message, and you let me know this work is not in vain. The greatest error in timing, the one that destroys the largest accounts, is the belief that price movements are isolated random events. This is the novice's error. He sees a high or a low, and he believes that the movement began today or perhaps yesterday. He fails to grasp the structural imperative of the major operation. He fails to see that every meaningful move on the tape is the result of planning, of calculation, and of patient effort by powerful interests. I learned that price, in the grand scheme, is merely a symptom. It is the final declaration of a campaign that began weeks or months prior. The real analysis for the intelligent operator lies in identifying the prevailing structural context. You must look past the daily fluctuations, the minor reactions, and the noise. You must ask, is the market currently in a period of calculated heavy accumulation? Is it the quiet phase where the big money is establishing its position in the dull zone? Or has the accumulation completed, giving way to the aggressive markup? Is the general public finally being invited to join the parade? Is the market now suffering from heavy, determined distribution? Are the powerful interests selling their holdings into the enthusiasm of the public? Or has the distribution campaign finished, leading to the necessary period of exhausted markdown and consolidation? Is the market punishing the weak hands? This is the structural imperative. If you cannot answer that question with certainty, you have no business risking $1. Price matters only after the phase is correctly identified. The movement must have a basis in the historical cycle. Timing requires a structural map, a blueprint of the market's behavior over time. Without this map, you are merely guessing your direction in a fog. I recognized early on that the market moves through 4 distinct powerful phases. They are cyclical. They repeat because the human emotions of fear and greed, hope and despair are immutable. We must map them. First, you have stall accumulation. This is the smart money phase. It is dull, it is quiet, and the prices often appear listless. This is where professional interests are meticulously buying shares from tired speculators and distressed holders. It happens in a narrow zone, usually after a lengthy decline has flushed out the majority of the weak accounts. Second, you have the markup, or the boom phase. This is the clear, undeniable trend. The stock has broken free of the accumulation zone. The public, sensing safety and momentum, joins the movement. This is where the profit is realized. This is the expansion phase. Third, we find distribution. This is the most dangerous phase for the average speculator. Prices remain high, often establishing new peaks, but the true interest has shifted. The professionals, having marked up the shares, are now selling steadily and silently into the public's enthusiasm and rising volume. It looks like a boom, but it is a liquidation campaign by the knowledgeable few. Fourth, we have markdown, or consolidation. This is the necessary period of correction. The distribution has overloaded the market, prices break down, and weak hands, who bought at the top, are liquidated. This phase flushes out the excess speculation and sets the stage for the next accumulation campaign. Successful timing is the disciplined application of the appropriate strategy to the current quadrant of the cycle. You cannot accumulate during the markup, and you certainly cannot hold long during the markdown. The greatest profits are realized not through aggressive action, but through disciplined inaction during the most treacherous historical phase. I speak of the consolidation phase, the dull market trap. Most speculators believe they must always be in the market. They confuse motion with profit. They feel that if the tape is running, they must be placing orders. This is the mark of an amateur driven by nervous excitement. The most profitable action in a consolidation phase is often no action at all. This historical period, where prices move listlessly sideways and without any discernible trend, is designed for one purpose: to bore the impatient speculator into premature selling or into entering premature trades that bleed his capital slowly. The dull market tests your nerves. It challenges your patience. It whispers, "Perhaps this time it will move without you. Perhaps you should just gamble on the direction." I mastered the art of waiting. I waited for the market to complete its dull, sideways phase entirely. I did not care if the phase lasted 3 weeks or 3 months. My job was to observe the structure. Timing, in this context, means knowing with certainty when the market demands you stand aside. It demands you conserve your capital. Capital is your weapon. When the market is dull, the best strategy is to keep the weapon loaded, clean, and holstered. Do not sacrifice your ammunition, your capital, in skirmishes designed to confuse and exhaust you. Wait for the major battle to begin. Wait for the pivot. A phase does not just fizzle out or abruptly end. It pivots. It transitions. This transition is not subtle. It is a declaration. The timing signal for the transition is not the first high price recorded after the low, nor is it a simple rise in the average price. The signal is the clear, undeniable break above or below a recognized historical pivot point. And this break must be confirmed by volume. The pivot point is that price level that the powerful interests have defended or held during the preceding accumulation or distribution phase. It is the boundary marker. When the price cuts cleanly and emphatically across that recognized boundary, confirmed by the force of conviction, by heavy expanding interest, the market is announcing that the structural game has changed. This pivot is the market declaring with finality that the operation has shifted from accumulation to markup, or from distribution to markdown. Waiting for the pivot confirmation is vital. It prevents the speculator from premature entry. If you buy before the pivot is confirmed, you are guessing the phase. If you wait until the pivot is clearly established, you are confirming the phase. I always prefer certainty to hope. This confirmation sacrifices the first several points of the movement. Let them go. Those points are often the riskiest. I'm not interested in catching the first point of the phase. I am interested in riding the major middle section with certainty. Once the markup, the boom phase, is confirmed, once the price has broken the pivot with conviction and volume, the demands of timing shift dramatically. During accumulation, timing demands patience and observation. During markup, timing demands aggression and nerve. The optimal timing strategy during a validated boom is not attempting to catch the absolute top or bottom of every single day's trading. That is micromanagement. That is for day traders who will be ruined by commission fees and poor execution. The true strategy is scaling. It is adding to winning positions on minor reactions. When a stock is clearly in the markup phase, every reaction, every temporary setback of 3 or 4 points is not a signal of distribution. It is simply the market pausing to shake out the nervous paper holders, those with weak convictions. This is the period where the market demands you ride the trend. It demands you hold your winning position and expand it strategically. I always bought in a rising market. I added when the market proved me correct. I scaled in as the phase expanded. This prevents the initial timid position from limiting the full potential of the major move. Timing the boom means recognizing that the trend is your structural ally. Do not argue with it. Do not attempt to sell on small rallies. Only liquidate when the price action and volume clearly indicate the distribution phase has begun. Until then, you are an investor in the phase, not a day trader of the tick. Truly great timing, the kind that separates the professional operator from the common speculator, relies heavily on historical analogy. You must view the current action not as a novel occurrence, but as the latest iteration of an ancient, repeating human drama. You must look at the current structural conditions and compare them to historical parallels. The instruments change. The companies change. The mechanism of the exchange changes slightly. But the phases of human psychology and organized manipulation never change. If the current accumulation phase shows the same manipulative characteristics, the long duration, the dull volume, the sudden bursts of buying followed by immediate selling designed to confuse, as a setup that preceded the 1901 boom, then the likelihood of a major markup phase developing is high. You are timing the structural integrity of the campaign. The core principle of understanding historical market phases, as discussed today, is often purchased at the highest possible price, the painful loss of capital. The stock market exacts a substantial penalty for ignorance. Thankfully, one can minimize this expense by utilizing the intellectual training ground provided by Edwin Lefebvre's seminal work, Reminiscences of a Stock Operator, published in your 1923. This text, where Jesse Livermore is chronicled as the fictional Larry Livingston, allows the serious student to experience Livermore's pivotal operational failures and eventual successes vicariously, sparing them the financial penalty of learning these lessons firsthand. However, to translate this essential wisdom fully for the mechanisms of the modern market, the detailed commentary and insight found within the Saatchias Max Davidson annotated edition is indispensable. A link to this essential edition is provided in the description below. History may not repeat itself exactly, but the phases of human psychology that drive accumulation, enthusiasm, distribution, and despair always rhyme. Your job is to read the signature. When you see accumulation that is long, tedious, and heavy, you are seeing the required structural prerequisite for a large markup. The larger the base, the higher the structure. Timing is confidence derived from history. When you recognize the current phase as structurally similar to the great campaigns of the past, you gain the conviction necessary to commit millions of dollars and ride the move until its logical conclusion. If you cannot identify the historical cousin of your current phase, you do not yet understand the game. The most expensive mistake in speculation is attempting to time the day the phase shifts. This is arrogance. It is trying to outwit the necessary mechanism of the market. Good timing means waiting until the phase shift is confirmed. This often means you miss the true low by several points. You miss the absolute high by several points. Let them go. Those points are not yours. Trying to catch the absolute low, buying before the accumulation is complete, is structurally identical to being wrong. Why? Because if you are early, you are trapped in the consolidation zone. You watch your capital erode or stagnate. You suffer the agonizing boredom of the dull market. You become impatient. When the market moves against you slightly, you panic. You liquidate your position right before the market finally pivots and justifies your initial analysis. Patience is the currency of the phase timer. Impatience is the guarantee of the loss. I learned to wait until the stock moved itself out of the accumulation zone. I was content to let others absorb the risk of the final shakeout. My timing philosophy is this: wait for the market to prove your initial assumption correct, then commit. If the market continues to consolidate, that means the accumulation is not yet complete. The phase transition has not occurred. Therefore, the time to buy is not yet here. Timing means sacrificing the possibility of the ultimate high or low for the certainty of the major move. A phase shift, particularly the transition from the markdown into the accumulation phase, is not a random event. It is often heralded by specific, identifiable institutional footprints. You must learn to read the signposts left by the powerful interests, the banking houses, the professional operators, the big money. They cannot hide entirely. Look for the disappearance of supply on minor corrections. When a stock has fallen for a long time, sellers flood the market. But as the smart money begins its accumulation campaign, they absorb that supply. They buy all that is offered. When the stock then suffers a minor correction, perhaps on a temporary bad headline, and the volume dries up immediately, and the price snaps back quickly off the defined support level, that is the institutional footprint. It indicates that the weak paper has been flushed out and powerful, calculating interests are now timing their acquisition. They are preventing the price from falling lower. They are absorbing the supply in preparation for the next phase. This does not mean you must buy immediately. This means your timing window for entry is approaching. The foundation of the next markup phase is being meticulously laid. Observe the strength of the rallies. Observe the resilience of the support. The stock's inability to fall, despite conditions that suggest it should, is the strongest signal that the phase is changing from markdown to accumulation. Volume is the market's truth teller. It is the final confirmation engine of a phase transition. Price moves can be manipulated for short periods, but volume certifies the conviction behind the operation. Timing the phase means ensuring that the volume is certifying the structural change. A true break from the consolidation phase into markup must be accompanied by expanding, insistent volume. If a stock attempts to break a pivot point on low volume, I treat it as a false move. It is a feint. The powerful interests are not committed yet. The phase has not truly changed. The accumulation phase must end with an undeniable surge of buying interest as the stock leaves the base. This volume expansion provides the necessary fuel and conviction. It is the announcement that the professional buying has completed its stealth phase and is now demanding attention. Conversely, volume provides confirmation during the distribution phase as well. A distribution phase will often see high volume on peaks, but the stock fails to make substantial upward progress. This is smart money systematically offloading shares into the public's excited, high-volume buying. The volume confirms that the interest is shifting from buying to selling. If you attempt to time a transition without volume confirmation, you are entering a gamble. You are betting on thin air. I will only enter a major position when the volume confirms that the big money is already committed to the new phase. Perfect timing, however, is incomplete without perfect risk management tied precisely to the phase structure. You must always establish your stop-loss based on the historical reality of the phase, not merely on a percentage of your capital. If the market is in a validated accumulation phase and it attempts to pivot into markup, breaking the consolidation high, but then suddenly collapses back into the consolidation range on heavy aggressive volume, the phase has failed. The entire historical narrative you were following has been invalidated. The professional campaign did not succeed. The expected markup is aborted. Your timing obligation is immediate, disciplined liquidation. Do not wait for a small rally. Do not hope that the market will reverse itself. The structural map has been violated. The failure to hold the pivot is the market's declaration of weakness. and it demands you recognize this failure regardless of the cost to your paper profit or loss. The man who argues with the tape, hoping that a failed pivot will somehow correct itself, is a man who allows a small setback to become a catastrophic loss. Timing the phase failure is just as critical as timing the phase entry. The failure of a stock to follow the structural course you mapped means your premise was wrong, or the powerful interests aborted their campaign. Either way, you must exit. You must accept the loss and wait patiently for the market to establish a new valid phase structure before risking capital again. This is the final law of the operation. Discipline is the ultimate market timing tool. The market is governed by the persistent repeating mechanism of human nature. Because human nature never changes, the greed, the fear, the boredom, the historical phases of speculation will always repeat themselves. Stop chasing the individual ticks of the tape. Stop trying to extract a fractional advantage from minor moves. Master phase recognition. Master the accumulation. Master the pivot. Master the distribution. When you trade based on the structural imperative of the historical phase, you stop trading based on mere probability. You begin to trade based on structural certainty. This fulfills the market's demand for disciplined action when the phase dictates aggression, and disciplined patience when the phase demands you stand aside. This is how you transcend the speculator. This is how you become the market engineer. You are filling yourself with knowledge, which is excellent. But knowledge alone won't make everyone rich, because not everyone possesses the right foundation. The market is the same for everyone. The only difference lies in the mindset. You can have a perfect trading system, but if you lack discipline and an understanding of your own psychology, that system is worth nothing. I often see a recurring theme in your comments. It is easy to talk about strategy in theory, but when it comes to the actual trade, many struggle with emotions. For those who want to focus on discipline, patience, and self-discovery within trading, I have created a new channel called The Stoic Trader. I believe it will help many of you bridge these gaps. So if you think this kind of content would be useful to you, go ahead and check it out. The link is, as always, in the description below.